So the second method that we can use to estimate the corporate cost of capital and the equity component of it is the discounted cash flow method. Essentially, this is the constant growth model that we talked about a few weeks ago in the cost in equity financing. And if you recall, the basic model is the expected required rate of return on the equity in equilibrium will equal the required rate of return, which is the expected dividend for next year over the current price of the stock today plus the expected growth rate. So again, where do we get those values? The current price you get from any website, the expected dividend that I showed you a few minutes ago before I crashed on the internet here. The analysts will project various earnings per share, and e.g. the stock market, the growth rate, you can get those from stock market analysts. So which input is a weak link in the DCF method? Why is that?
Similar to the data, I guess,
Growth rate.
based on what we expect the growth rate to be, but that's not indication of past performance.
Right. So it's actually, I think, even worse than beta because beta at least has some historical basis, some historical analytical database to it. Growth rate is really an estimate, a judgment of how fast is this organization going to grow over the next foreseeable future. Yeah.
So what was that answer?
The weak link is the growth rate. Similar to beta, because beta we're assuming the past is going to be like the future, which is an historic assumption. But in the DCF method, we're assuming that the growth rate estimates are going to be pretty accurate. And that's, again, a pretty heroic assumption. So we have the simple illustration here, the $40. We can get that from any website that shows the current price of the stock. The expected dividends, the analysts will usually have an estimate of what the dividend is going to be. And then the growth rate estimate, and in this example it's 5%. We do all this arithmetic and find that the required rate of return on equity is 14%. And then finally, the last method, which we haven't talked about before, is called the debt cost plus risk premium method. And what that is it's the difference between the cost of equity and the pre-tax cost of debt for a given business. In other words, we take the average firm in our industry and we look at the average rate of return on equity and the average cost of debt, and we look at the difference between those two numbers. We can then use that and add that onto our basic cost of equity to come up with an estimate. So let's just go through an example here. We have assume the current risk premium is 4%. So we're going to look at the average firm in healthcare, and we find that the required rate of return on equity for the average firm is 14%, and the average cost of debt for a healthcare firm is 10%. So the difference between the 14 and the 10 is 4. So what that means is, sorry, I'm in finance, I'm not very good at math. So the 4 percentage points represents the difference between the cost of equity and the cost of debt for the average firm in healthcare. And that's called the risk premium. Not the market risk premium, which comes from the capital asset pricing model. Just the risk premium. So then all we do is add that 4% to our organization's cost of debt. So if we know that on average the difference between the cost of equity and cost of debt for the average firm in healthcare is 4%, and we know that our cost of debt is 10%, we can simply just add the 4% to our 10%, and that gives us a rough estimate of what our cost of equity is going to be. So I rigged the examples that they all came up with 14%. So we've got 3 different methods, and they all get the same answer in this example. However, what happens if they're different? And they could be radically different. What do you do, Sarah?
The book said, I think that you would take the average of the 3 if they're pretty similar, but if there's one that's considered really dissimilar, then they can select to exclude that one, but it basically depends on the practice of the hospital.
Okay, so that's a analytical approach. What about a less analytical approach? Can you think of one reason, circumstances under which you might want to use one versus the other?
See what someone else is using for theirs with similar business interests.
Okay, comparator. Yeah.
If you're risk averse, you might go with the one that's the most conservative.
The most conservative or the most, what do you mean by?
If you're risk averse, yeah, you would go with the one that's most conservative. So I guess the one that has the, I haven't thought about what value would be better or worse, but the one that's going to, you know what I'm saying?
Yeah, I do. Yes, I do. So can anyone think of an example? We've got three methods there, CAPM, DCF, and debt cost. Can anyone think of which one of those models would not be relevant if I don't pay dividends? The DCF model, you cannot use the DCF model if you don't pay dividends, because that's what the model is based on. So for non-dividend paying companies, they're going to be forced to use CAPM or the debt cost plus risk premium method. If you have a lot of confidence that beta in the past is going to be similar to beta in the future, you may weight the CAPM higher than, say, certainly a back of the envelope approach like the debt cost plus risk premium method. So you have to use judgment in which of these approaches you're going to use. So now we bring all this together, and we're going to have target weights. We're going to assume target weights of 35% debt, 65% equity. We're going to talk more about this in 2 weeks when we talk about capital structure. But for now, just assume that for every $100 worth of capital that we have, we want 35% of it to be debt and 65 cents of it to be equity. So that's what management has decided is the optimal capital structure for us. So how we now calculate the corporate cost of capital is to take the weights, and we're going to weight the different kinds of capital, the equity by the amount of equity and the debt by the proportion of debt, to come up with a blended weight. So in this example, the 35% is the rate, is the proportion of debt. We've got 10% is the cost of debt, and we've got 1 minus the tax rate, which is 60%, the 0.6. On the equity side, we've got 65% of our capital we want to be equity, and we've got a required rate of return on equity of 14%. We do all the arithmetic, and we find that we have a cost of capital, corporate cost of capital of 11.2%. So what does that 11.2% mean? It means that each dollar of new capital will consist of 35 cents of debt at an after-cost tax of 6% and 65 cents of equity at a cost of 14%. So I'll just repeat that. It means that for each dollar of new capital will consist of 35 cents of debt, an after-tax cost of 6%, and 65 cents of equity at a cost of 14%. So we can now use that as our benchmark rate. What if the business is for profit but does not have publicly traded stock? Again, the problem is going to be estimating the required rate of return on equity, in which case the best thing to do is what Bradley suggested a few minutes ago, which is examine cost of equity for similar types of businesses and use the debt cost plus risk premium method. Now we turn to the issue of not-for-profit. So the for-profit corporate cost of capital has got some fairly well-defined methods. For the not-for-profit, circumstances change. Again, the required rate of return on debt is done in exactly the same way in not-for-profit as it is in for-profit. except there's no tax effect. There's no need to multiply it times 1 minus the tax rate, because the tax rate is 0. The problem is the cost of equity. And as is the case with many things in finance and economics, you get 5 finance people in the same room, you'll get 5 different opinions about what to do. So there are 5 hypotheses about the cost of fund capital, or the cost of equity capital to a not-for-profit. It has 0 cost. Why would someone think that the cost of equity to a not-for-profit has 0 cost?
You don't have to pay it back or anything.
You don't have to pay it back, and not only that, do you not only have to pay it back. The people who are donating the capital, what do they expect from it? Nothing. So they have no investor, there is no required return on it because investors expect no required return. So that's one hypothesis, that there is no cost of capital or equity in a not-for-profit. The second hypothesis, that is a cost equal to the return foregone on marketable securities. So why would someone propose that? What's the logic behind that?
The opportunity cost. It's like it's either money they could have invested elsewhere.
Exactly. So somebody donates $1 million to our healthcare organization, or we have $1 million in retained earnings. We can spend it, or we can invest it. And then by investing it in marketable securities, if we don't do that, then that's an opportunity cost. So the second bullet is really the opportunity cost argument. You can't just leave retained earnings, charitable contributions lying around. If you do, there's an opportunity cost of doing that. The third one is a little more obscure. It has a cost equal to the expected growth rate of the business. What would be the logic there?
You would think, you would want the asset to grow at the same rate as your organization, basically. Like you would want anything you invest in to grow at the same rate as your business.
Okay, yes, why? Just tell me a little bit more about that. What are the consequences if it doesn't grow at the same rate?
The growth rate will decrease. The growth rate will decrease.
I think what Cecily's arguing is that you want the return on your equity to match or exceed the growth rate of the business. And I'm saying that's correct. But why? Robbie?
Because if the return doesn't match it, then you're going to have to take on debt to keep up with the demand, which increases your debt ratio.
Yeah, and you may not be able to take more debt if you already have a lot of debt. So the point you're making is that unless the return on equity matches the growth rate of the business, I mean, think about it for a second. If the growth of your services is 5-6% per year, and you're getting 1% return on your equity, what's going to happen 10 years from now when you need to build a new building? You're going to have way more business than you have money to pay to expand your business. So this is a pretty powerful argument, in my view, having a rate of return equal to the expected growth rate of the business. The next one, a cost equal to that required to maintain credit worthiness. What's the logic there?
Because your credit rating in part determines how much you would have to pay for taking on debt.
That's right. So this argument is because your credit worthiness will affect the rate of return you get on equity will affect the cost of debt, that you want to make sure that Standard & Poor's and all the other fellows and men and women who make decisions about what the bond rating is going to be of a healthcare organization, you want to make sure they're happy and that you maintain your credit worthiness so that you maintain your bond rating and you minimize the cost of debt. And then finally, the argument that is the theoretically purest argument, but probably the least practical, is a cost equal to the cost of equity to similar for-profits. And the argument there is if you've got two organizations that are identical in every way, except one is for-profit and one is not-for-profit, and essentially they face the same opportunity cost of capital, and therefore they face the same opportunities in terms of foregone opportunities to invest in alternate projects. Therefore, the cost of equity should be the same for both of them. I think the bottom line is that the third and fourth bullets are probably the most practical rules to use when coming up with cost of equity for a not-for-profit. Certainly, if one is higher than the other, in other words, if you have to maintain a fairly high growth rate in order because you've had some problems with your credit worthiness recently, then you would probably want to go with a higher rate. The higher rate between those two, the expected growth rate or the rate to maintain credit worthiness, whichever is the higher, is probably the most logical ones to choose. I will not ask you to read Hamada's equation. That was a great paper, got him tenure, but it's not a lot of practical use to it, so you can skip over that.